Hey friends, welcome back to the channel. I'm Iggy, and usually we're diving deep into long-term strategies. But today, we're hitting pause for something urgent. A major piece of analysis just dropped from Dr. Wealth. They've uncovered 3 Singapore REITs that show strong 10-year gains of at least 86%, but have actually posted negative returns over the past 5 years. This isn't just another headline. It's the kind of opportunity that can transform your SGX portfolio if these stocks are truly ready for a mean reversion comeback. I've sifted through the noise, and I've boiled it down to 5 crucial points from this article that you absolutely need to understand. Forget the jargon. Forget the endless paragraphs. I'm going to break down these key takeaways, and more importantly, immediately tell you what they actually mean for stocks you own or are watching right here in Singapore. We're talking about real-time impact, real-time insights right now. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I also focus on regional and global economic trends. If you want to stay ahead of these rapid market movements, stick around for my immediate take. Let's jump right into this. The first critical point from this Dr. Wealth analysis is that 3 REITs, Frasers Logistics and Commercial Trust, Mapletree Industrial Trust, and Mapletree Logistics Trust, have all posted negative 5-year returns while maintaining strong 10-year gains. So what does this mean for Singapore investors? This pattern suggests a classic mean reversion setup. These aren't failing businesses caught in a death spiral. They're quality assets that got hammered by the high interest rate environment that peaked in 2023 and 2024. Think of it like a strong swimmer being pushed underwater by a wave. They're still strong, just temporarily submerged. The second key takeaway is that all 3 REITs are strategically shifting their portfolios toward high-growth sectors like logistics, industrial properties, and data centers. For a trade-dependent economy like Singapore, this is significant. Frasers Logistics and Commercial Trust now has 104 logistics and industrial properties out of 112 total properties, with a portfolio occupancy rate of 93.9%. Mapletree Industrial Trust has transformed into a data center powerhouse, with over half its portfolio value now in data centers across North America and Asia. Mapletree Logistics Trust manages 180 logistics assets across 9 Asia-Pacific markets, with a 96.2% occupancy rate. These moves position them perfectly for the e-commerce boom and digital infrastructure growth that's reshaping Asia. Moving to point number 3, we're now seeing the interest rate tailwinds these REITs desperately needed. The U.S. Federal Reserve cut rates by 25 basis points in September 2025, with analysts at Citi expecting further cuts of 125 basis points from September 2025 to March 2026. How does this hit home for us? Singapore's 10-year government bond yield has already dropped from 2.87% at the start of 2025 to just 1.91% as of September 30th. The 3-month SORA fell from 3% in January to under 1.5% by October. Lower borrowing costs directly boost REIT profitability and make the dividend yields more attractive compared to T-bills and fixed deposits. This is the exact catalyst that could trigger the mean reversion Dr. Wealth identified. For even more detailed charts, the full official report breakdown, and my exclusive commentary, make sure to check out our Substack linked below. It's where I put all the extra facts and figures for you to dig deeper. Point number 4 from this analysis is that these REITs have maintained conservative financial management despite the tough environment. Frasers Logistics and Commercial Trust has a gearing ratio of just 36.1%, with 69.7% of debt hedged at fixed rates, and an interest coverage of 4.5 times. Mapletree Industrial Trust maintains gearing around 38%, with 78.1% of debt hedged, and achieved positive rental reversions of 9.2% in Singapore. Mapletree Logistics Trust executed disciplined portfolio rejuvenation, selling older assets for 209 million Singapore dollars and reinvesting in modern, green-certified properties in growth markets like Malaysia and Vietnam. This financial prudence means they're not over-leveraged and can weather economic storms better than weaker REITs. And finally, our fifth crucial point today is the sustainability angle that's often overlooked. Frasers Logistics and Commercial Trust leads with 72% of its borrowings in green or sustainable financing. Mapletree Industrial Trust has completed its third phase of solar panel installations, exceeding long-term targets ahead of schedule. Mapletree Logistics Trust has 51% of its net lettable area under green leases. Why does this matter for your portfolio? Institutional investors and major tenants increasingly demand ESG-compliant properties. These green credentials aren't just for show. They attract higher quality tenants willing to pay premium rents, which translates directly to better distribution yields for you as a shareholder. So that's my immediate take on this potential REIT comeback story. The key insight here is timing and patience. These three REITs, Frasers Logistics and Commercial Trust, Mapletree Industrial Trust, and Mapletree Logistics Trust, spent the last 5 years navigating one of the toughest rate environments in recent history. But they used that time wisely, upgrading portfolios, maintaining high occupancies, and positioning for growth sectors. Now, with interest rates finally falling and Asia-Pacific REITs already delivering 16% total returns since January 2025, the setup for mean reversion looks compelling. My quick piece of advice: don't get caught chasing momentum after prices have already surged. If you believe in Singapore's role as a logistics hub and Asia's digital infrastructure boom, these names deserve serious research. The market may have overlooked them during the rate hike cycle, but quality assets with strong fundamentals don't stay undervalued forever. Stay agile, stay informed, and always consider how global rate movements filter down to our local SGX. So that's my immediate take on these potential REIT comeback candidates. In today's fast-moving market, staying on top of opportunities like mean reversion, plays with solid fundamentals is absolutely critical. If you found this quick breakdown helpful, please give us a like, share this video, and subscribe to the Investing Iguana channel so you don't miss our next urgent market commentary. And for those who want to be truly ahead of the curve, our premium members get exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's real-time reactions and urgent insights on major market shifts directly to your inbox, giving you a significant edge. It's just $3 a month, about the price of a cup of coffee. Think of it as your daily dose of market agility directly from my desk, giving you the jump on everyone else. Ready to stay ahead? Just click the link in the description below to become a premium member today.